Hello and welcome to Hedgeye NexGen. Where we are going to continue to break down finance into its simplest form and help you build wealth. We're joined by new fan favorite. That-
I don't know if new fan favorite is the best way to describe it, but it's always good to be here with you, Richie.
you were in the intro too.
I did great intro, great new intro by the team. No, it's now these are always fun, right? Being able to connect and I love the interaction online.
Yeah,
The chat's been pretty good. I expect it to be good today as well.
I think it will be.
But nevertheless, we're not going over restaurants today, but we are going over volatility.
Volatility. We could go over restaurants. One of these episodes, it could just be all about restaurants.
It's in the queue.
Okay.
We've talked about this. It's in the queue.
I'm ready. I've been waiting for restaurants. It makes my job easier, first off. But what people might like to know today, we're not going to piss off that many people.
No.
Our last
That's a
episode,
good thing.
a lot of people, some people liked it. Some people were like, "Hey, that's a little mean." But you know what? Losing money is also mean.
Yeah, and the last time we did this, right, it was like the wall of shame, right? It was the worst of the worst of just terrible characteristics of exactly what you don't want your money in, and the reason why you're probably trying to find a better way.
And today's episode's kind of similar, right? About on that. It's not exactly wall of shame, but right, we're talking about volatility, right? And understanding what volatility is. And part of that is understanding sometimes you gotta get away from volatility because it can be like a freight train. And I don't know if you saw, did you see there was actually, it was, anyway, there was it was one of those automatic robots.
Okay.
But they just go on their own, like they do deliveries now.
Okay, like DoorDash, like they're rolling out, yeah.
Yeah, and one of them got destroyed it got stuck on a train track, and a train track
no.
came, just absolutely
Nailed it.
demolished it. And we're gonna try, and that's what volatility can do to people. And so we're gonna try to not be the the robot stuck on the train tracks.
Definitely not. Definitely not. So what are we talking about today?
All right, we're gonna break down volatility into like any angle that you can see it, because I think there's a lot of people look at kind of just one, like they see the VIX and like what even is the VIX, right? But then also there's a distribution of returns for stocks, gold, or Bitcoin that I think it tells you a lot more about what people actually expect versus the reality of what it actually is. And so we're going to get into that. But first, I got to do a quick shout out because one person did send in an ETF for us to look at.
Oh,
Jay Lauderdale. We're going to look at it next episode, and we're going to put it on the shame of the wall of shame. But I just didn't have time today.
we'll put it up there with the chicken sandwiches. We'll rank that with the chicken sandwiches. We'll put that somehow into the rank.
I am a junkie for chicken sandwiches, so I don't think you understand. I'm ready.
We'll see. We'll see.
Keep going backwards and see. We got new chairs, people. All right, volatility. Also, we have a chat. You can go into the chat. We'll hear you. We'll talk to you. So volatility, at the bare basics of what it is, it's just how dramatically price swings up or down. So if you have a lower number, then you just don't expect very large swings. It kind of stays in a very close range of just a close range. When volatility increases, your range gets a lot bigger. What do you mean in terms of range? Well, if volatility is low, you can expect like a 1% move on the day or a 0.5% move on the day. Volatility gets high, you can get 10% moves, 20% moves. The range of outcomes increased is a boatload, okay? So it's kind of like higher vol is rough waters. It's the freight train. The lower vol, you're just stepping into the kiddie pool. Nothing wrong with a little kiddie pool. You just maybe there is something wrong if you're a little bit older, but anyway.
Everybody could. Yeah, you put your feet in.
You can put your feet in the kiddie pool.
Bathing in a little kiddie pool when you're, a full-fledged adult.
Yeah. Okay, but yeah, lower vol is the key pool, right? It's very calm. There's no big waves, not a lot happening. You're just splashing around. It's very calm, okay? That's what low vol is. Then the other thing that, honestly, I was kind of learning a little bit about this too. Okay, so volatility one, it's measured in percent terms. What is that percent? So if you see a VIX and it's VIX 20 or VIX 15, that's 15%. Okay, and what that is, that's an annualized percent. And all it means is that you would expect market returns to deviate plus 15%, minus 15% in either direction. So if you take you take the average return and just you can deviate in 15% in either direction. That's what that percentage is doing. It's an annualized percent, which is it's kind of cool. So we put it up here. So when we go into this first one, this first graphic. So I just kind of put your analyzed.
Can you make that chart any smaller before we get into what's on this slide? I mean.
Well, you know what the good part of this is? Most people are listening, so they don't even see it.
Oh well, I'll give you a little call out there. Anyway,
well, I'm the blind one here.
Well, hold on, let me take my glasses.
Yeah.
Go on.
Okay, so if you see a annualized vol of 15% on your daily move, approximately what you should expect is plus or minus 0.9% of a move. Okay. You see a 30% fall, you should expect plus or minus like 1.9%. When you start to see a 40% fall, that's plus or minus 2.5%. 60% vol on a daily move would be about plus or minus 3.7%. So just it can go up or down about 4% on the day. Wow. That's what 60 vol is. When you start getting up to 100%, so 100 vol, that daily move is approximately 6.3%. So on average, you should be seeing a move of up 6 or a move down 6. Wow. Okay? So that's what volatility is. Okay? And I think that's where a lot of people are missing, just don't understand that. That it is. I mean, a 6.3% move to the downside on one day is a boatload, right? I think Bitcoin yesterday was down 14%, 20% on the day, and then it's up now 9%. That's just normal, okay? When vol is as high as it is, which it's currently around vol of 60 on Bitcoin. So that's just the first piece of this, okay? But we're gonna focus today on gold, right? We've had a long gold position here at Hedgeye, which we're proud to say. We're bag holders in the literal sense because we have bags of gold, physical gold. We don't bag hold something, but we're gonna focus on gold. We're gonna then go into Bitcoin, and then we're just gonna show how gold acts as an asset and how it trades, and then we'll compare it to how gold trades and the differences between the two. Okay, so first up here, second chart. Here's your gold implied volatility. Okay, what is implied volatility? Essentially, it's just what the market expects volatility to be in the future. Okay, realized volatility is your past volatility, so historical, backward looking. Implied is what the market believes the future will have, but it's in percentages. It's the same annualized percent, same thing. Okay, so gold volatility, it peaks at about 64%. In 2011, got to 40%. In 2020, got to about 50%. In 2026, so just recently, a couple days ago, it got up to 46. Okay, it's currently right around 35. All right. So what happens when gold goes to these extreme levels? So that's this next chart. We'll look at 2008 to 2009. So from 2008 to 2009, gold volatility went from about 20 all the way up to 65. Okay, and while it did that, it went down essentially about 25%, then shoots up to about another 30%, and then crashes back down 27%. Okay, it's that's what you get when your volatility is at 65 to 50. Okay, you get these wild swings, and a really big thing about volatility is you don't want to get suckered in. Okay, because what you're going to see is you're going to see like gold did on this chart. It's the blue line. It crashed, right? It went from 978 to 747. It crashed, and all of a sudden it goes up about 10-20%, right? And then you're like, oh, the bear market, it's over, right? Well, no, it goes back down from about 900 back down to 712. So if you bought that so-called dip, you lost your money on the way down the first time, then you lost it again on the way down the second time. It's almost like we go back to this robot getting ran over by a train. You get your robot.
Survives.
No, it doesn't.
Back on the track.
No, I don't even think it survives. It gets hit by the truck. A repairman, engineer comes, fixes it up, says, "All right, little guy, go get him," lets it loose, and then gets stuck on the railroad again and gets ran over. And it's dead twice. It's almost like a cat, but with two lives. That's basically what that's like. It sucks. We want to live here. We're livers.
We're optimists.
Very much optimists. And so that's the whole right. But that's the thing. Like 60 vol, 50 vol. It's not the kiddie pool. It is. You can lose
You're in the ocean.
Yes.
You're in the ocean.
You are deep in the ocean without a life jacket. No life jacket. Just stranded. Yes. Exactly.
And a big wave is coming.
a big wave is coming, and you got to risk manage that wave. Okay? So, and the whole point too is that's normal during when you have volatility at that high. You should expect that to continue to happen, and it will continue to happen because we'll get into volatility clusters and all this other stuff. And then afterwards, gold does, once volatility goes from 64 and then starts to normalize back down to 25, yes, gold then starts to go up about 39%, right? But that's just, it had a trend, volatility lowered, and it became much more of a nice calmer weather. You guys started to get a little bit closer to that island, okay? Let's go to 2011, 2012. It's the same story again, right? In 2008, right, it was gold to the downside, then to the upside. In 2011, it was gold to the upside, right? So volatility acts in both ways. So it doesn't mean that high VIX just means that something's crashing. When you look at gold volatility, and the VIX too, when volatility goes up, it could be that it's crashing to the upside, okay? And that's what's currently happening. Or happened. But either way, you can see, so gold volatility went from about 15 all the way up to around 40, right? And gold went up 28% in about a month, okay? And then afterwards, after volatility started coming down, gold then crashes back down to 19% because it's lower than where it was, gold volatility at 40 goes down to 30. GVZ of 30 is a large amount of volatility in an asset. You can still crash from 30 just because it's a lower doesn't mean that it's all gone. It can still go. And it can go in either direction. And also there's a lot of important things on this, but when something crashes, the quicker something crashes to the upside or downside, the more violent the move is going to be in the other direction. So you have to think like it's a rubber band. When you stretch out a rubber band a lot.
It's a great analogy.
Thank you.
This is going to be a great analogy.
So when you stretch out that rubber band a lot, what happens is it will snap back forward. The further you stretch it, the more it's going to snap back in the other direction. But when you do it very quickly and you snap down, it's going to snap back up and then back down. It's time as well as the magnitude impact the future moves that you're going to see in either direction. It's just like when you're out in the ocean, deep in the ocean. It's rough out there. You're stranded. It's rough. The waves can come from either directions. It's all the same thing, right? But you have to be very careful of when you see a move that is very quick to the upside. it will come down. And when it comes down, it's going to come down a good amount. It's not going to come down like 1 or 2% like you would like it to, because we know that you should expect at vol about 40, you should expect like a 3 to 4% move, if on average, right? And so we'll keep going here. We'll go to our next crash in gold volatility terms. Gold volatility in 2013 went all the way up from about 15 up to about 35. Gold just crashed 28%. If we go to the next chart here, yeah, no, this is 2019 to 2021. I definitely messed up that title, but that's okay. It's okay, everybody. So at the beginning of the pandemic, what happened was gold volatility went from 10 all the way up to 50. And actually what happened was gold crashed down 12%, and then kind of stayed around that 30 vol range, and gold goes up 40%. Right?
It's crazy.
That's a snap right there. I snap downwards, and then I'm snapping back up, and that's just
Yeah.
it just is what it is, right? You almost never know the actual direction, right? Obviously, we're trying to predict out directions of where things are going based off of our fundamental views. But the reality is, once you're actually trading something, it's a lot different than having a fundamental view on it. When you're trading, you have ranges and distributions of where asset prices can go. And when you're increasing your volatility, your distribution of where prices can go just increases. And when you snap forward, your distribution gets even larger. It's all like this whole big thing, trying to get the trend right, but you can get whipsawed and hurt by a little crashing market.
Yeah, evidently, right? And if you're on the wrong side of that, I mean,
It hurts.
and that's where Hedgeye comes in, right? I mean, right, being able to get out of something and not stay too long.
Yep.
Right? Not just bag hold and watch something implode on you.
Yep.
Right? Keith sends out the various signals on whatever it is that you're interested in, right? Whether it's stocks or ETFs or greater flows, right?
The greater flows.
Greater flows.
But yeah, no, it's absolutely right, because we've done episodes on this, and it's about drawdowns, right? When you're drawdown, what you have to do is you have to make more. So like if you lose 25%, you have to make more than 25% to get your capital back. When you lose 30, 40% in a day, you have to make more. You have to make more than 50% on the up move just to break even. And the whole thing is, why would you wear that? Why would you wear a 40% drawdown when just be down 0%? If you zero is making money compared to being down 40.
Not losing money.
You're just not losing money, because really what's happening is you're actually making money, because everybody else down 40, you're at zero. When you go to the line, you say, how much money do you have? Well, let's put it this way. Let's all start at $100. All right. We both start at $100. You and I. All right. You didn't wear any drawdown, so you still have your 100 bones.
I got my Ben Franklin.
Yeah, you got your nice Ben. I wore the drawdown. I wore a 40% drawdown, so now I have $60. Who's richer?
Sorry, Richie.
Bennett is richer. Right? Yeah. You made money, right? Comparatively to me, you're making money. I'm a loser.
Right. And although my displacement is 0, I have more money than you.
Right? Now imagine if you just put that money into something that's actually going up too, and then maybe you even have $120 versus my 60, right?
Right.
A lot easier to grow from those numbers. So yeah, that is why Hedgeye is here. We'll keep going here on what happened with gold volatility in our current cycle, right? So we got long of gold, all right, and this is what gold volatility did. We were just on the right side of it, all right? Gold volatility spiked to the upside, and gold just crashed to the upside this time, right? So it first went from about 15 all the way up to 32, and then gold went up 31%, and then it stayed at that level for a little bit and shoots up further to 46 vol, and gold returns about 63% in a short order. So it says 2015.
I mean, the titles are...
Jesus Christ, Ryan. Wow. Yeah, everybody. I'm going on a baby moon in about, I don't know, a couple minutes.
Couple, yeah, I was gonna say,
It's-
should we cut this, Gendron, should we cut the slide 8, the Starbucks Black Book here? I mean, no.
when is that?
Keep going, Richie.
When is
We already
it?
had 2 of them.
Okay.
Keep going. This is great.
Okay. And so yeah, that's what happened. This time it's just that gold went to the upside, right? But now you've seen gold come down a little bit. It's come down like 15%. But again, that's just normal. When you're at gold volatility at 46, you should expect it to go in either direction in a large move.
Right.
You should just expect it. That's just like the volatility is telling you the game that you're currently playing, right? You can't ignore it. When you're playing chess, there are rules to the chess game. You would know where the pawn is or where your king is. Volatility is the same thing. You should know where your volatility is because that's the game that you're playing. And the game changes every single market day, every single second. All right, so next we're going to go into distribution of returns. So for everybody, this is called the normal distribution. So
A bell-shaped curve, if you will, Richie.
a nice little bell-shaped curve. So the way you read this is so that the middle line, that's called a mu. Is that mu?
Yeah, I believe that's a sign for a mu.
It's average, right? So that's your average return. You can see that's the peak. So that's where you'll see the most, your returns most often. And then the other little sign, it's a standard deviation. So it's your +1 standard deviation on either side. When you're at +1 standard deviation on either side, you should expect 68% of your outcomes to be within that range. So just think it's minus 0.1% return and a +1%. Let's just say that's a 1 standard deviation move. 68% of, if you just look at gold, daily returns from 98 to today, 2026, 68% of those daily moves are going to be in between -0.1 and +0.1. Now, I don't know what the actual 1 standard deviation move is in gold, but maybe I should have done that homework before this. But either way, the whole point is a 1.0, 68% of your returns are within that. 2.0 is 95% of your return. So if you have something that's greater than a 2.0 or a 2.0 Z-score move, it's all the same thing. That's a rare move, all right? When you have something greater than a 3.0, 99.7% of your distribution should be within that range. So you should not see a greater than 3.0 almost ever in your lifetimes.
Right.
Like it's a once in a lifetime, if you're lucky, type of move. Okay? So that's the normal distribution, right? And so we'll get into this, but that is really what people think that assets return is a normal distribution. They're wrong. It doesn't. A lot of people know that, but maybe if you're new to this or you're just welcome, the distribution of returns for assets is not normal. And so we'll go to this next slide here. Okay, so this is what gold's returns are versus what they would be if they were a normal distribution. So on the right, once again, I made it as small as I could. You're welcome. Okay, but on the right is your simulated normal return. So what I did was I basically said with gold's volatility of what it actually is, what would be its return, right? And you can simulate that. I simulated it for you. And then on the left is gold's actual returns of what it's done since 1998 till today. So the first thing that you'll see is the average. So the average return, daily return for gold is a 0.04%. Okay? It's a 1 standard deviation move. It's 1.06%. So that means, okay, if we go to our example that I botched earlier, so a 1.0 standard deviation move. What that means is for gold, its return between -1.0, well, it's not 1.06. Okay, -1.1 versus plus 1.1, 68% of your daily moves are between those two numbers, negative 1.1 and plus 1.1. Okay, everybody? Then 2.0 standard deviation is you just times that number by 2. All right. Now, gold's true returns. Its minimum, so its minimum return on a daily move was down 9%. So that means on a single day, gold was down 9% once. Okay, and then on another day, it was actually up 11% once. In a normal simulated distribution, the lowest gold should have ever have gone would have been down 3.5%, and the highest it should have gone was up 3.5%. Okay, negative 3.5 and plus 3.5 on a daily move. Gold was actually, what it actually did was up 11%, down 9%. That's not normal, okay?
Yeah, not even close.
It's not even close to normal at all. And so how do we do this? How do you know that's not normal? It's something called there's skewness and kurtosis, okay? So, we weren't going to get into math, but we're getting into some math. Okay, skewness is symmetry and asymmetry. So just imagine it's just symmetry, right? A butterfly is perfectly symmetrical, right? So a perfectly symmetrical thing will have a 0.0. Asymmetrical will lean to either one side or another side, okay? Kurtosis, okay, that measures how fat your tails are. So if you go to the other chart, on the left back one, go back one. Yeah. So tail is this plus 3.0 standard deviation. If that's higher, if it's like winged up, that is kurtosis, okay? And so a normal kurtosis is 3.0. But I measured excess kurtosis, so it's all around 0. So when we go back to where we were, the kurtosis, as you can see,
and kurtosis
on the next slide,
is the height, right?
It's also that.
It's quite literally the height in that curve, right?
Yeah.
Positive kurtosis is, this is my math.
You're coming in. Here we go.
The math major in me.
Get excited about the kurtosis, please.
But kurtosis is the stretch of it, right?
Yep,
and you can
that
either
too.
have, if your normal curve is, call it 0 here, right?
Yep.
And positive kurtosis, right? Your bell-shaped curve is higher.
Yep.
The negative kurtosis lower, and then with skew, right? That's left to right, effectively, is what you're saying.
Exactly. And then kurtosis also has tails. It also has the bigger tails. Bigger in the middle, bigger on the outside, skinny on the skinny. We'll show you what it actually looks like in a second. But if we go back to slide 9 here, so gold's kurtosis is a 7.1. Excess kurtosis is 7.1. Okay, so that means 0 is normal for this example, and anything above that it has fat tails. That's fat. That's a fat boy tails. All right.
Fat tails.
Fat tails. All right. So let's go to our next chart here. So this is typically what you would see with the distribution of gold.
Like a normal distribution.
It looks like one, but this is gold's distribution. We know it's not normal based off what we just saw.
The actual.
This is actual. This is actual. What's going on with gold? Okay, but you guys can't really see anything from this. It looks pretty normal to you, but that's okay. Let's go to this next slide. Okay, actually, I put it in a line. You can kind of start to see those little winged ends over there on the ends. Good thing most of our viewers are listening to us, but either way, viewers,
it's a flatter bell.
Yeah, you can't really see anything yet. So let's go one more. Oh. Here we go. So the black line is gold's actual returns, and the yellow line is what gold's returns would look like if it was normal.
Truly normal.
Okay, and so as you can see, they're not the same.
Right.
They're not.
You have positive kurtosis.
Yep.
Right. You have that stretch.
Yep.
And no skew. Right. No skew.
The skew is
not too bad.
It was super minimal.
It's super minimal.
So it's pretty normal. And then you can kind of see the tails there, right? It's just kind of sneaking up on you. You don't really see it in this picture, but don't worry, guys. We got you. Let's go to this next chart.
Oh, there it is.
Okay, so this is called a QQ plot. This is just looking at gold's returns. And so a QQ plot is a normal one would be in a straight diagonal line. This is not normal. So let's just skip this, go to this next slide. Here we go. So the blue is a normal QQ plot. It's supposed to be a straight diagonal using our simulated returns. The what is that? Gray line, that is gold's actual returns. And now you can see at the two ends, you can see that gold's returns on the ends are a lot bigger. They're not hovering around that blue line. If it was truly a normal distribution, the gray and the blue would be pretty much identical. It's not. You can see those fat tails. Okay? Why does this matter? This matters a lot because when people say, oh, that's a 6 standard deviation move or a 3 standard deviation move, that should almost never happen in your lifetime. Well, when you're talking about asset classes and gold and any of the asset classes, S&P is the same, Bitcoin's even more, we'll get to that one, you should expect those. They happen a lot more than any normal distribution. So you should expect extreme moves in either direction. It's not a once in a lifetime thing that's going to happen. Maybe it's once every 3 times in a lifetime. Okay, it's still not like it's going to happen every day, but it's going to happen. And the higher the volatility of something, the more often it's going to happen. So if gold volatility can peak about 40 and Bitcoin's volatility peaks at about 100, well, then you should expect bigger moves in either direction with Bitcoin more often. Okay, we'll show that in a bit. But this really kind of shows you guys this graph. I love this graph. I just learned about this graph not too long ago. Shout out to the CQF. Anyway, it's a certificate, everybody, that I was taking. But they taught me this. Anyway, well, they taught me this graph. But also what's kind of interesting too is this also kind of shows that there's regimes. Okay? When this is gold. When gold's volatility is a lot lower, right? You can see that the blue line and the gray line, they kind of overlap. So what this is also saying is when gold's volatility is a lot lower, it actually shows normal distribution or a lot closer to a normal distribution of returns. It's only when volatility starts to increase that you get away from having a normal distribution of returns. And that's pretty important, right? So when volatility is at let's just call it 15 or lower, you can expect a normal distribution of returns. You should expect that, I shouldn't see a down 10% day. That should never happen or almost never happen. But when your volatility goes all the way up towards about 30 or 40, you should expect that large move is going to happen. You don't know when. It's going to happen, though. So, yeah, I hope that makes a little bit of sense. Mm-hmm. QQ plots.
Like QQ plots.
Yeah. Was this in your math class?
It wasn't in the math class.
It was not?
No.
Look at that.
I studied math theory in college, and we didn't. Not a lot of plots.
Not a lot of plots.
A lot of theory. No
I would love to hear your theories.
I don't know if I have any theories. More just proving them out.
Oh, I hated that. I failed math many times. I didn't really fail math. I shouldn't say that. I wasn't good.
Don't out yourself completely. Okay.
Well, here's the thing. Give me a computer, I can do better math than anybody in the world.
I believe you.
But give me it just doesn't work. I'm gonna blame dyslexia. I'm gonna blame my parents. Actually, no, I don't think I can say this one. I don't think I can say that one. Well,
what's next?
I'm trying to think if I have an angle to share this story. Anybody in the chat?
No angle. No chat. No angle.
No.
Keep moving.
God, bastards.
Probability.
Okay, probability of an event happening. Okay, again, I picked great colors for everybody. You're welcome.
Great colors.
Terrible colors.
A lot of decimal places.
Okay, so a Z-score, right? This is just what I was trying to show is a probability of an event happening. You know how people say, "Oh, that event is a once in a two chance of happening. It's 1 in 2. It's 1 in 1,000 chance of happening to you." And I don't know what the lottery is, but it's pretty high. Okay, so for z-scores, it's the same thing. So when you see a z-score of 0.5, that's equivalent to like a 1 in 2 chance of something happening. It's pretty much almost 50-50, but you can see the actual percent of what it would be. Once you get to a 3.0 z-score, that is when you start to see oh man, this is all a 1 in 370%. Okay, when you get up to a 6.5 z-score, 6.5 z-score, that is 100,000. A 1 in 19.8 billion chance.
Crazy.
And then once you get to an 8 or a 10 z-score, Excel didn't even do the math for you. It literally gave me divide by zeros. It's a 1 in.
Yeah.
It doesn't exist.
Not happening.
Never, ever happening. Okay, but as you can probably guess, is we're going to see these types of z-score moves all the time in returns and within returns. And so that's what we're going to show now. When we go to our next chart, we'll keep these numbers in back of our heads. Here's gold return from 2008 to 2009. This is your daily returns. Can't really see anything. I guess this was the show of, I'm going to put graphs just to show you what normal people show you and then say that you can't see anything and try to make it better. So let's go to this next chart here. This is what happens. What I tried to do then was, because what happens with returns, it's positive or negative in either direction. So you get like these spikes and it's really hard. So what I started to do was, all right, I'll just absolute value the z-score so that it doesn't go all the way down and then all the way up. But in 2008, there was a 10.0 z-score event that happened in terms of gold's returns. A 10.
And that's in absolute value terms.
And that's, yeah.
Interesting.
So it's either up or down.
Yeah. It's just, you're looking at momentum, right? Momentum, essentially.
It was either up or down, but the up or down move was a 10.0 z-score event of happening. Excel doesn't even calculate how much of a probability that is, but we just saw it. And then you go to the next day, or one of the next days in 2008, it was a 6.5 z-score. Okay, that should be a 1 in 19 billion chance of happening. Okay.
Crazy.
But they're all around each other. You can see these z-score moves are all around each other. And that's the whole point. It's not actually a 1 in 19 billion or a 1 in math doesn't exist number. They happen all the time because they have fat tails, and volatility happens within the returns of our assets and our asset classes. And so yeah, that's what we got there. Kind of make sense on that?
Totally.
Okay. All right. Let's just further prove this out. Let's go to the z-score for gold's returns from 2025 to today. That's slide 18. So you can see like the returns of what you would say it was like an 8 standard deviation move, or an 8.0 on a z-score basis, and or 4.0. Again, very unlikely, improbable events of happening, but they happen. Okay. Then the next part is, let's go into how often things cluster and where do they cluster, right? So that's what we're going to show you on this next chart. What I started doing was, I was like, all right, let's take a 30-day count of 2.0 z-score moves. So essentially, if a 1 day return was a greater than a 2.0 z-score move, count it as 1 and just track that on a 30-day basis. Okay, and so that's what this chart is showing. And just remember, you shouldn't have the probability, the actual probability of having over a 2.0 plus or minus z-score is a 4.5% chance of happening. It should be a pretty low number. But as you can start to see here is that the volatility it clusters around each other. When you start to have these extreme moves, you see more extreme moves. Okay? And so in return speak that, or in the not non-theoretical world, like this is actually like pretty big. They write a lot of white papers on this. I kid you not. I had to read a couple of them, 50 pages, just explaining this. You guys are lucky. You're only getting 40 minutes. But what really all that's important here is volatility clusters around itself. So when you see high volatility, you expect high volatility to come afterwards. Okay? And when you have very low volatility, you should not expect the higher volatility. In fact, you should expect, like we saw in the previous charts,
It ramps.
exactly, it ramps up and then it clusters around itself. It's called volatility clustering.
Because you had that period from like 2017 to 2018, and then you saw the spike in October of 2018, and then again in 2019 a little bit higher of a move,
Yep.
right, on the rolling count, and then in 2020 obviously
Yeah.
the highest. Now, well, 2020 is probably a bad example. You also saw that in 2024, right, coming in from 2023, ramping in early 24, and then really accelerating in 25.
Yeah. And you just see more of these extreme moves closer together.
Right.
And then when volatility, let's go to this next chart. So when volatility is lower, you expect not a lot of these moves to happen. And so that's what this is showing. You have the black line is gold volatility, the blue line is your rolling count, and you can really see it here. When volatility ramps up, your count of extreme moves follows. And when gold volatility goes down, your count of extreme moves goes down. And that's what it is. So, but the whole, really a big point of this is when you see volatility at 40, 50, 60, you're going to see extreme moves. And you don't want to be on the wrong side of those. You just don't want to do it. And then when we go here to this last chart on gold, okay, I just started to show you was this is your distribution of returns during different periods. So as you saw in the previous chart, from 2017 to 2018, it was pretty much a normal distribution. There wasn't any extreme moves. Volatility was basically at 15. But in 2009 and today, you've seen extreme moves. Well, in today's period, and in 2008, there was extreme moves. And what you can really see it here, the difference in the distribution of your returns in different periods. The 2017, when you look at its kurtosis and its skewness, it's pretty much normal. Yeah, it's just pretty much normal. Its average return actually was only, well, sorry, not its average return. Its min and max return was a 2% to negative 1.7%. Remember, when we simulated the normal returns, it was a 3.5% to negative 3.5%. So it showed a little bit less volatility on the min-max scale, but your kurtosis and skewness were pretty much normal. Once you get into today's period, your kurtosis, which is how fat the tails was, went all the way up to a 7.6.
Wow.
Okay, that's big. That's massive. Okay, your min to max was you've had a negative 8.9% down day and a positive 6.1% up day. Okay, on a min max scale. In 2008 to 2009, your kurtosis was a 4.0. Like an excess kurtosis. So, and you can just see that orange line, that's a normal distribution. Those red and purple lines, that's not normal, right? You can see those fat tails, and you can really see in 08 because it was a longer period that we were measuring. Okay, and so again, like expect these big moves in higher vol. It is when you get into higher vol, you're no longer in the kiddie pool. You're just not in the kiddie pool. And you should expect non-normal. Okay, let's go to Bitcoin. Bitcoin realized volatility. Okay, difference between implied volatility and realized volatility. Implied is what the market's expecting in the future. Realized, it's what happens in the past. Okay. And so, by the way, on GVZ, the gold volatility, its average is about 20. Bitcoin's realized volatility average is 46. So on average, Bitcoin is trading where gold volatility usually peaks.
Yeah, it's crazy.
Okay. That's the asset Bitcoin is. That's nuts.
Right.
That is absolute nuts. In 2021, Bitcoin's volatility, by the way, in realized volatility too, it's the same thing. It's the annualized volatility that we went over in the very beginning. Okay, in 2021, Bitcoin's realized vol, it peaked at 106. That means that on an annualized basis, you could have expected Bitcoin to go up or down 100% on average, up or down. That's absolutely wild. 2022, its vol was 94. 2022, again, it was 80. 2025, it went to 61. It's currently only at 62. It can get up to 100. It's
Crazy.
And volatility clusters around itself. So this volatility spike, it just started happening.
You can see the ramp, right? You can see that similar ramp to what we've seen in other charts in the deck, right? The recent ramp.
Yeah.
Right? You started to see that coming into October. Then it really play out in, what is that? That's November.
Early November.
Right? Goes back down and then skyrockets here.
Skyrocket.
In Jan, Feb.
It's only at 62 right now.
Crazy.
Only at
it
62.
could be. And they cluster around each other.
Clusters.
And so...
yeah,
man,
it's just no joke. Bitcoin is no joke.
Well, the volatility of Bitcoin is no joke. Like, right?
Yeah,
This isn't.
Well, when you're trading something that's not. You're trading something where the average experience is being out in the middle of the ocean with the big waves.
I mean, I don't want to swim in the ocean every day.
Every single day, it's like that. Every day. You want to swim in the ocean? No, I don't want to swim in the ocean. I'm not a surfer. I can swim, but
okay.
Yeah, that's what Bitcoin is. That is the game that you're playing.
That's a good analogy, right? It's like that's the game you're playing. You're getting dropped off in the ocean every single day.
Sink or swim.
Sink or swim every single day. This isn't the kiddie pool in the backyard. This is, and it just it caters obviously to risk but like if you're risk off and you're getting into like it's a recipe for disaster. And probably, too, a lot of the negative reaction that you're seeing online, right, to this and, depression and everything that has, people losing all of their money, right? Their entire, nest egg on an asset class where, whether they like it or not, they are back in the ocean with no lighthouse, no life preserver, and no support boat to bring them back to shore.
And vol of 60 means it can go down another 60%.
And the conditions could get way worse.
From here. Imagine it goes down 60% from here. It could happen on average.
Totally.
It could go down even more than that. And that's the whole point. I keep saying that. I'm doing my best here. But either way, it's crazy. Bitcoin is crazy. Mm-hmm. Now, I get it. Yes, it can go up 60%. I guess so. But you better be on the right side of it. And you better not get suckered in at the top and then get flushed out like our poor little robot, right? We don't want to be the robot. Don't want to be the robot. So yeah, let's go. Let's look at what happened with Bitcoin volatility spiked in 2020. So here we go. Bitcoin in 2020, its volatility went up to 95. It went up 495%. Which is like, it's absolutely insane. And then it went down, and then it went back up to 106% and then crashed 57% from there. So net, you were probably, if you just held it during that period, you're probably up, I guess, maybe 200%. But you guys, you should not see that as, oh, look, I'm up 200%. That's crazy returns. No, that is like not the point of this whatsoever. It's that you can lose, like imagine you invested close to the top at 63,000 and it goes down to down 53%. If you put in your $100, you now only have $50. Okay. And that's how assets and returns work. It's all if you got up 495% and then you got out, great job, right? Like that is the goal. I'm happy for you and so forth. But the problem is that most people are not getting out and they're holding it and or getting in at the top and they're losing 53% and you're down a lot. And as well, Bitcoin vol was at 106. 106.
Yeah. Crazy.
On our next chart, here's 2022 to 2023. So the other side, right? Volatility works in both ways, up or down. Bitcoin in literally 2 months, it crashed 59%, and its vol went from about 30 to 94. And then it kind of stabilized a little bit and then crashed even further. It vol went right back up to 80 and it went down 64%. Whew. It's wild. Let's go to this next one. This is your Bitcoin volatility 2025 to today. So it peaked at about 125,000 and volatility has steadily gone up. It went from 20 at its peak to 40 to now up to 62 vol, and it's down 46%.
Wow.
And again, maybe it's up 8 or 9% today, but you should expect it to be up or down very large because its vol has not gone away. It's still 62. It could be up 10% tomorrow. And then guess what? It could be down 30% the next week. So whole point of volatility, your range of possible outcomes as volatility increases gets wider. Okay. And and Bitcoin, by the way, it dropped 23% in the last day or week or whatever it is. I don't have the exact number. It doesn't really matter. It dropped 23% in a week. So that is a really quick snap downwards, which means it could snap back upwards and then snap back downwards in the same amount of time. Objects in motion tend to stay in motion. Okay, here's Bitcoin's returns versus what they would be if they were a normal distribution, as well as if it was versus gold. So you can see Bitcoin's actual returns. It's min versus max. Well, first off, it's one standard deviation move is 3%. So that's up or down 3% is a one standard deviation move. That's a lot. Okay. Its min max is its max drawdown versus max draw up is 15.87 in either direction. If Bitcoin was to be normally distributed, those numbers would be down 11 versus down up 12. And again, that's a 1 day move. That's not like a 1 year move. Imagine it's down 16% on 1 day or up 16%. It's absolutely insane. Its skewness is actually pretty perfect, which is crazy. Kurtosis, again, fat tails, 3.57. And versus gold, gold actually has fatter tails. But you can see too with gold, right? Remember, its volatility peaked at about 46. Bitcoin's vol averages 46. And you can see that going on in the min max and as well as the standard deviation of moves, right? Standard deviation of a 1 day Bitcoin is 3% versus standard deviation of gold is 1%. That's 3x it. And you can see that versus the max and min drawdown. So yeah, Bitcoin is not gold on a volatility basis. And if we go to our next chart here, so I did this to you guys just to kind of mess with you. So I put Bitcoin's distribution of returns on the same chart that we had gold, right? You can remember the gold chart and min or maxed out in terms of its distribution at down 5% to up 5%. So I like to mess with people just so you can actually see Bitcoin versus gold. So this is the distribution of Bitcoin. And you can see it has down 5% to up 5% days all the time. You can see those wings. I mean, that's almost like a stick figure right there, right? But you can see those wings, okay? So Bitcoin volatility, because it's a lot higher, has bigger moves in the up or down direction. And yes, I played with you guys on that chart. I know that's not how you're supposed to do it, but I don't care. I prove points out here.
The wings.
It's like a little stick figure. Here's our next chart. We're going back to our QQ plot, everybody. Let's go.
My new favorite plot.
I think it's my favorite plot. So the gray is Bitcoin's true returns versus, and then the blue is the simulated normal returns. Do we have any chat?
I got it. Let me switch over here.
And you can see disappointed in that.
Just told me to turn up Bennett's mic.
Oh,
I gotta get closer to the mic.
well, thank you.
I'm explaining kurtosis back here when I should be explaining right here.
Well, thank you to Less Noise for helping our broadcast. See, this is why we love the chat, and we love Less Noise.
I'm not used to being in this studio. I'm used to being in the main studio, and I can move around. I can annotate.
Draw on board.
Well,
Starbucks Black Book. Okay, we'll go back to our QQ plot. Okay, so here's what you got. We're going to start with the tails, right? And we're actually going to start with the blue line. Blue line is normal. It's a diagonal line. That's what Bitcoin's returns would look like if they were normal. But you can see that, right? So if they were normal, the gray would be on top of the blue. It's not normal at all. And you can see that those tails are a lot bigger when you get to the extremes. What's also interesting, if you guys remember, gold, when you're at lower volatility, it almost matched the blue line, which meant like at lower volatility, gold was actually pretty close to a normal distribution. When you look at Bitcoin here, when you look at that chart, the gray is not really that, it's close to the blue line, but it's not exactly on the blue line. So even when Bitcoin's volatility is lower, it still doesn't trade like a normal distribution, which really just means Bitcoin's not normal. There is nothing normal about Bitcoin in any way, shape, or form. It's one of the most volatile assets in the world. But yeah. QQ plots, everybody. Let's go to our next chart here. So, and again, your volatility clusters. And you can see that here. You can see the blue is the count of the extreme moves, and the black is the realized vol. And you can also see that the blue, in terms of when you went to 2021, it had 100 observations. That means there were 100 days where there was 100 consecutive days where Bitcoin had a greater than 2.0 standard deviation move that happened. Okay, greater than 2.0 move should only happen about 4.5% of the time. There are 100 consecutive days. Yeah. It's a lot, guys. It is a lot, right? And so, and that's, again, when you have higher vol, you should expect that. And we just saw Bitcoin, its vol just got to 62, and we know that it clusters, and so we know that it's going to go up really fast, and it's going to go down really fast too from here, okay? And when we go to our next slide, this is the last slide of the deck here, right? Every asset class has different volatility and volatility characteristics. Okay, the black is Bitcoins. The blue is like the S&P 500. It's the VIX. The gray is GVZ or gold volatility. Gold volatility and the S&P 500 volatility. Gold is a little bit. It's less volatile than VIX. Okay, so you can see the blue line is often over the gold volatility. So gold should have a lot more normal distribution, less fat tails. And then you got the black line is gold or is Bitcoin. And it's like, it's not even in the same universe, Bennett.
Yeah, I mean, it's the move is just insane in the vol. And
look at that vol. It's almost never at below 25.
Right.
And usually people have a panic attack in the S&P 500 when the VIX is above 25.
Right.
It almost never goes below 25.
Crazy.
That's just the asset that it is. And so, guys, you gotta know the assets that you're trading. Now, for some people, they day trade it.
If you risk lover, You're going to be swimming in the ocean. You're going to strap a few stakes around your waist, and you're going to, go out in a storm, and you're going to ride the wave of volatility.
But it's much more of a sophisticated thing for somebody trading Bitcoin. Like if you're trading Bitcoin every day, it's a lot harder than if you're trading gold every day, because the volatility is just two different things.
Right.
And so but the thing is, a lot of people are in Bitcoin. There are a lot of people in our generation that they're just doing it not really even on the side. They just heard of Bitcoin from an influencer and they invest in it. And they're just not.
You hear from an influencer.
Yeah, pretty much.
In a
right?
podcast studio, perhaps like this, Richie.
Yes, but we are.
This is I would like to think this is much higher integrity than.
I bet you those other ones are not talking about QQ plots.
Yeah, God, no.
Nobody's talking about QQ
Kurtosis.
plots.
Are you kidding me?
They can't even spell kurtosis.
Well, I don't know if I could either.
Maybe not. But either way, right? Most of the people in Bitcoin, first off, they just don't even know that volatility exists and that different asset classes have different volatility. But then also they don't really realize that you can lose a boatload of money very, very quickly. And things in motion tend to stay in motion. And volatility clusters. And volatility just went to 62 on Bitcoin. It can go to 100. It can also go down. It can go down, and then if it goes down, it could be a less volatile crashing market, or it can go up in 10 years. The whole point is you have to understand the game that you're playing, and you have to play that game. And we're really here just to try to help people risk manage that, right? Because if something's going against you, we always say get your ass out, right?
True.
There's no reason to drown, no reason to get hit by a train. If you can move away from the train, you should move away from the train.
Right. Well, it's intuitive, right?
So yeah, that's volatility.
Volatility. A little master class on vol, kurtosis, skew, normal distributions. Maybe a little math. Maybe some spelling. All
in time for a little vacation.
Ooh, yeah. Best wishes to you, Richie, next week. Safe travels and
and
back in the studio for a little sandwich review, perhaps.
Yeah, please save me. I can only talk about math once.
That's it. That's an easy activity to come back into.
Yeah, we need something exciting, fun. We just hit people with math. They need some food. They need food. I need some food.
Love it.
I need some food. I do
drinks. Too. I'm starving.
I need some drinks. I have not been able to. I've not been able to drink since my wife's. Well, I can drink, but you feel so. She's pregnant, everybody, or pregnant, however you want to pronounce it.
I didn't know there was multiple. I
didn't
know there were multiple pronunciations. No.
It's great. They say pregnant, pregnant.
No.
Oh yeah, so I just call it different words.
And you're not drinking. To support. To be a great.
Here's the thing: she can't drink, right?
So you don't want to be in the living room just
schmammered.
Yeah.
Absolutely schmammered. While
you're a good husband.
Try to be sometimes. All the times.
All
the time.
And on that note,
we're going to wrap it up there, everybody. Thank you for joining us, and thank you to Less Noise for being in the chat. We'll make sure to make more noise in our later episodes, especially once we have some food on here.
Boom.
And we're going to do that in 2 weeks.
Put it on the calendar.
We got Starbucks coming up. I'm Hedgeye AI. He's
Hedgeye Food.
Hedgeye Food. Give us some likes, subscribes, Twitter post. Talk to us. We can't get lonely out there. You can talk to us.
Never lonely.
Never lonely. Never lonely day in the office. Thank you everybody for joining us. Good luck out there.